Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value, how we're doing by the metrics, our buying power, how we used the $500+ that was in the portfolio, as well as our watch list. So jumping in for today, I just wanted to let you guys know I do apologize for Thursday and Friday not posting, but President Jimmy Carter actually passed away, so the stock market was closed for those 2 days, and all flags are supposed to be at half-mast until the end of January. So that's why I didn't post on Thursday and Friday. The markets were not open. But as of right now, we are down $113.95 for that 1 week mark. We're up almost a little over $1,400 with a near 3% return. That 1 month mark, we're up $1,300, 2.68% return. Then that 3 month mark, we're up a little over $1,000 at 2.1%. Year to date, we're not so focused on because it's only been a month. That 1 year mark, we're up $10,520, 26%. Then all time, we are up $25,160.42, a 98% return all time. And guys, you can see there have been peaks and valleys, you know. COVID hit, we got down to like, originally it was 33, because remember I took 10,000 out, but down 23,000 now with the change in the portfolio value. Then we bumped back up, dropped a little bit. We hit a new peak in August of 21, dipped again, and then we reached the highest peak we've had, which was about 45K, dipped again. You know, the market ebbs and flows, but now we are at an all-time high. So yeah, it was a little rocky here between 2022 to 2025, end of 2024. But overall, guys, time in the market beats timing the market, and that's so important because a lot of times you'd make more money just owning good quality businesses than you would buying and selling out of good and bad ones. And overall, there's only been a few businesses that have really been pushing the portfolio. And jumping in, let's take a look. With that $500, I did buy 5 shares of Realty Income. So guys, this is at a lower cost per share than I was at before. 5 shares, $260 of market value. Average cost is $51.75. 0.51% of the portfolio is in Realty Income. Today we're up $1.70. Total we're up $1.70 because the trade actually went in on Monday morning. So those metrics will change as time goes on. But I did buy back 5 more shares of Realty Income. Now, I did get some questions like, why did you sell out if you were just going to buy back in? For a couple reasons. One, I wanted to pay off all of my debt. So that was the main reason I wanted to pay off all my debt. 2, Realty Income was at the best loss for tax loss harvesting, and I'm not going to have to pay taxes on that loss. So it actually lowers my taxable income. And 3, it's a good quality company that I still want to own. I saw that as a loophole. Just because you sell a company does not mean that your views on it have changed. Maybe you find a better opportunity than the current option that you're in. There's nothing wrong with that. So even though, say, like I like Apple more than Realty Income, that doesn't necessarily mean that there's not a spot for Realty Income in the portfolio. I like that monthly consistency. I like that growing dividend income each month, and that is an important part of my portfolio. So I want to build it back up to like 170 to 200 shares. Will it take a while? Yeah. But I'm here for the everyday grind. Every share that I buy, my income goes up a little bit more. And so it's nice to have Realty Income back into the portfolio, and I'm excited to keep growing that share count. Then we got Altria, ticker symbol MO, at right around $51 per share, 320 shares. $16,300 of market value. Average cost is $47.27. 32% of the portfolio is in Altria. Today we're up $24. Total we're up a little over $1,100 with a 7% return. Guys, Altria just paid us a massive dividend of $326, which now, as long as Apple stays below $300, I can forever, and Realty Income will help with this too, but I will forever be able to buy a share of Apple the next month, and that's the goal, using the current month stocks to buy next month's stocks if they are at a good value. That's the most important thing, is you don't want to buy a stock if you think it's overpriced. So Altria is 100% doing its job and doing it phenomenally. It's been, such a lagger for the past, like if you look at the 5-year chart, we haven't seen highs like this, since 2022. So you could have held the stock for 2 years and been down on it, and you just broke even in September. So I mean, from April of 2022 to August or September of 24, and then you hit a new high and it's down again. But it ebbs and flows. Tobacco is one of those things, especially Altria with their Juul investment, and divesting that capital as well has helped free up their balance sheet, because Juul was just a drag, right? They tried to invest for the future. They did the right thing. They did the right thing in their space by trying to get into a trend that was going to provide them more profitability. But overall, it lagged. There was a lot of unknowns, and regulation just destroyed that product to the point that it wasn't viable, and it wasn't a viable stored for capital and growth in the future. So, I mean, you have to praise Altria for trying, right? They're trying to diversify. They're trying to change the perception of just being a tobacco business into being more than just tobacco, which is good. But they also have to be strategic with that, because, losing, technically they just wrote off that investment saying it's dead, and, we're going to take a loss on that capital. So they honestly probably would have just been better to pay a special dividend or increase the dividend by a higher percentage than invest in Juul. But, you live and you learn. Altria is still paying a great dividend. They're still a dividend king. They paid through COVID. A lot of companies can't say that. They increased through COVID, not only paid, but increased through COVID. And that's something that, you really have to give it to Altria and the management team. They know how to run their business extremely well. Even with that bad investment, they still held strong to their overall, goals of rewarding shareholders. And overall, guys, it's kind of insane to see Altria up, 7%. It's been so far like this year, because it's usually a downer. Usually it's sitting at like 47 to $48 a share. So even though it's only like $2 or $3 higher, that's still a great that pretty much matches, 7 to 10%. If you've owned Altria for a month, for a few months, like say November, December, you've made some money. If you bought it in October and you've held it since now, you've made a little bit of money, which, if you look at the chart, it hasn't been like that, from, like, you could say if you've held it from 2017 until now, you're losing money on Altria. I mean, if you don't factor in dividends. But, this is a great time to be in the stock. I think management has really capitalized on that Juul mistake, and I'm excited to see where they go in the future. As long as they pay their $3.26 to me a month, they're good with their capital and overall profitability, I'm good. I'll buy a share of Apple every single month, and I sleep easy with the stock in my portfolio. Next up, we got Coca-Cola at $61.72. This is my favorite pop. I'm literally drinking one right now. But I have 15 shares, $9.26 of market value, $60.54 for the average cost. 1.82% of the portfolio is in Coca-Cola. Today we're up $10. Total we're up 18 with a near 2% return. Guys, this is going to be one of the big five in the portfolio, and my goal is to try to buy this at a decent value. Right now, it's up about 2%, so I still could buy it here, but I want to buy lower than my average income or my average cost, so I'd want to buy it below 60 or around 60, so right now it's a little too pricey for me. That PE ratio, I believe it's at like 22, 25. Yep, is a little rich for me for Coca-Cola, just because the growth isn't as high. I would rather buy an Apple at 22 PE than Coca-Cola. But I also understand that, there is a premium with this brand, with Pepsi, with Mondelez, with Hershey, with companies that have a great brand recognition and products. But I feel like there's a certain ceiling for consumer staples when it comes to, like, yes, it's a good brand. Yes, people buy it, but the growth is very slow. And the dividend growth is also pretty slow. So I would rather put my money into something like Visa that has a higher growth rate than Coca-Cola. That's why it ranks higher in the overall, like, standings of where I want the final positions to be. But Coca-Cola will be a juggernaut for me And I love the brand. I'm excited to own more shares. I just want it to be down a little bit below that 60, around that 60% or $60 range. So it's sitting at like a 2% bump up, which again is not bad, but I just wouldn't buy it at these prices. I'm pretty, I'm pretty tough about when it comes to when to buy my positions, and that I'm not willing to go below that level. Then we got Apple at 233.56, 10 shares. So I did buy, Altria did buy me a share of Apple. So I'm at a even 10 shares now at $2,300 of market value. Average cost is about $220 a share. It did go up a little bit because, my average cost was above my average cost. About 4.5% to 5% of the portfolio is in Apple. Today we're down $30. Total we're up 146 with a 6.5% return. Guys, Apple's going to be the single biggest position. It's one of those that I just want to keep ticking the box, keep buying it. Once we get my girlfriend's car paid off, I can probably be putting like about $300. I gave her $500 towards the car this month, but we're trying to help each other get out of debt. She was helping me a lot as well when I was paying off credit cards and paying off the cruise that we took last year. So we're trying to be good stewards of our capital, good managers of our money. And the first thing is to be debt-free, no car payments. And so the beautiful thing about the portfolio now is I don't have to put in $250, $300 a month to buy myself more shares. Altria, with money left over from T. Rowe Price, bought me 5 shares of Realty Income and 1 share of Apple, and I'm good with that for this month. So once her car is paid off, I'll be putting probably a good $300 to $400 a month added in capital into the portfolio, which I'm excited about. And a lot of that is going to go towards Coca-Cola, Apple, and Visa, and Realty Income. And eventually I'm going to add Google and Berkshire to that list too. But right now my main focus is Apple. So I'm happy with the position, guys. Just watch it keep climbing. 5.5% is nothing. I want it to be close to like a 15 to 20% position. Then we've got AbbVie at 177. We've got 95 shares, $16,800, nearly $1,700 in market value. Average cost is $95.19. 33% of the position is in AbbVie. Today we're up to 27. Total we are up $7,800 with an 86.5% return. So guys, the crazy thing about AbbVie is, it's been such a great grower for me when it comes to appreciation. The dividend's been a great grower as well. They know how to invest back into their business. I'm not worried about them long term. I know it was pretty shaky during the merger, and I took advantage of that. And it's really paid off. And one of the things that I do like to stress here on the channel is that, it's important to watch what, Bill Ackman, Warren Buffett, Charlie Munger did when he was alive. Like, it's important to look at these people like Monish Pabrai and see what they're doing with their money. It's interesting to see what these billion-dollar, players in the market are doing with their cash, seeing what deals they're taking advantage of, seeing if you agree with those deals. I did a video of like last week talking about how Warren Buffett just bought Pool and Domino's, which doesn't necessarily mean Buffett bought those, but his lieutenants could have. But it is interesting to see where he's finding value and his lieutenants are finding value, but that does not mean you need to copy what they do, which that, on the flip side, is what happened with AbbVie. So instead of buying companies like Pool and Domino's, he sold AbbVie a couple years ago. He only owned it for like a year. And I'm like, that just doesn't seem right to me. I've done my analysis. If I wanted to be a sheep, I would have sold out, and I probably would have made a good 3 to 5K, but I'm at $7,000 now. I'm making $150 a month every quarter that this pays, and I would have missed out on great gains. So think for yourself. It's like you don't want to like just because one mechanic says this is wrong with your car, you take it to another one, you get a different opinion. That's what it's like with investments. Like I could say Domino's is a bad deal, and I think he spent too much cash on it. Obviously, he saw he saw value in it. Otherwise, he wouldn't have bought it. And he's way more educated than me. Like I'm just some 29-year-old kid that took up stock investing at 22. So he's obviously way more educated. He understands balance sheets way better than me. He's studied companies for like 80 years. So like 75, 80 years. So just because you don't see the value in something doesn't mean that he made the wrong move. And just because he sees value in something doesn't mean you should jump into it. I understand AbbVie's business because I studied it. And maybe they've said in the past at Berkshire meetings before that they should have bought a basket of pharmaceuticals. They never did. So I've seen him dabble in like Davina. He's done AbbVie. He's done Bristol Myers Squibb. He's done some pharmaceuticals. But I wonder if that's him, like as in Buffett, or one of his lieutenants. Because if he doesn't, understand something, he doesn't hold it for long. So that kind of makes sense why he would churn and burn a couple of pharmaceuticals, simply because that's not his expertise. And a lot of times you can tell by who's buying by the size of the position. If it's smaller, it's usually not Buffett. If it's a really big bet like Occidental Petroleum, it's definitely Buffett. So just saying that, like, it's important for you to use your own head, to use your own mind, to use your own brain, to use your own life experience when it comes to investing. And don't just follow your favorite investor, because they could make a wrong move. They could jump into, like Bill Ackman bought Netflix. I love Netflix. My girlfriend and I watch Dexter a lot. That's like our habit show. I understand the business. I understand they run ads. That's how they make their money, and through subscriptions. Now they have a lower tier and they get ad revenue, but they get their money mainly from subscriptions. And so I understand the business model, but I don't understand how to value it. And that's why I was in and out of Disney too. So it's like, you don't want to jump into a stock just because a famous investor jumps into it. You have to be honest with yourself and really be clear if you understand the business. So I took time to invest, and I did a lot of research on AbbVie. I did a lot of research on the company that they acquired. And I said, together, apart, they're both like 70 or $80 a share. By the price of Humira, by Botox, I think they're worth, 150 to 180, sitting at 170. So I did a really good job analyzing the company. It's gone up in value. The dividend has gone up, which I'm mainly a dividend growth investor. So it's really fit the goals of the portfolio. And, I've just been steadfast, diamond hands, and I held it. And now I'm up, 8,700 or 87% with, an $8,000 gain and $150 a month. So just make your own investing decisions. Don't follow a stock or purchase a stock because somebody on YouTube said it was going to go up 15, 20%, whatever. Make your own investing decisions. It's really important. And it honestly, it's a gift to be able to analyze companies. Like, read Buffettology, read the financial accounting statements of Warren Buffett, read the Snowball. There's a lot, Tap Dancing to Work. There's a lot of books that show you kind of what he does. The Intelligent Investor, honestly, is the best one to read if you want to learn how to analyze stocks. But anyway, sorry, I didn't mean to go on a rant, but I'm just saying, like, it's easy to follow, but use your own brain and make your own decisions, because that's where you get your best returns. If I would have followed Buffett out of AbbVie, I would have made some money, but I wouldn't have made this amount. I wouldn't have made this amount of appreciation, and I wouldn't have made this amount in dividend income every month. So it's been such a blessing to own AbbVie. And then next up, guys, we have got Visa at 306.04. We got one share. Average cost is $268.29. 0.5% of the portfolio is in Visa. That will go up in time. We're down $1.65 today. Total, we're up $37. 14% return here on Visa. Guys, this is going to be one of those that I buy pretty heavy once it drops, if it drops below my average cost. And I could see that not happening, but that's why we have alternative investments in this month. And then next up, guys, I know this one's a bit controversial. I've got Walgreens. I switched it out for T. Rowe Price because I understand excuse me. I understand Walgreens. Here, I'm going to take a drink real quick. I understand Walgreens cut the dividend last year, but the profitability is going up. Last earnings call did really well. They had like 51 cents of earning EPS for the quarter, and as it's sitting right now, it's more than doubled my dividend income. So yes, I understand the quality of the company. They're on shaky ground right now, but that's where AbbVie was at when I bought it, right? That's the point. You want to buy these companies when they're kind of in a turbulent time, because then you get higher returns. So I have 1,200 shares, $13,800 of market value. Average cost is $9.73. 27% of the portfolio is in Walgreens. Today we're down 306. Total, we're up 2,100 with an 18% return. Guys, I bought this like last Monday. So I've made almost 20% on my money in a week, which is insane. That's not what I'm going for. I bought it shortly before the earnings release. They did a really good job on earnings. They did a better outlook overall for the company. The main reason that I'm buying this though is because I know the dividend was cut last year. It was 48.5 cents. Now it's 25 cents. But with my share count, the same amount of money that I had in T. Rowe Price made me $125 every 36912. Now with Walgreens, I'm making $300. So if I can boost up realty income, if I can buy some more Visa, I'm gonna eventually have the same amount of income for this set of months as I do with the first set. And so the next goal after this is to get $300 in that second set of months, which will be Apple, or I'll be bumping up the realty income, because as of right now, I'm not going to be purchasing any more AbbVie because my average cost is so high. But as of right now, I make a little over $300. I make like 330 now. In the first set of months, I make around 150 to 160 with the second set, and then with the third set of months, now I make $300. So the reason I switched from T. Rowe Price to Walgreens is simply because the dividend income more than doubled. I know Walgreens is going through a turbulent time. They cut the dividend by 50%. Guys, the thing is, they could cut the dividend again by 25%, pay me 12.5 cents per share, and I would still make about $20 more than I did in T. Rowe Price. Now, there's nothing stopping me from, let's say Walgreens goes to like 25 or something, and I have like a $30,000 position. I don't think it will happen, but say it does. I could easily see myself switching back into T. Rowe Price. I have no issue with T. Rowe Price. Love the management, love the business. I understand the business. I've held it for multiple years now, but it's just too good of an opportunity to pass up. And I just feel like if I'm truly trying to get more dividend income, I feel like now the dividend is safe. The payout ratio is about 50%. Like the overall economic outlook for the business is a little bit better. And I have such a huge share count now in Walgreens that, even a little bit of a gain, like we're up $2 and I've made over $2,000. So if it drops down below my $9.73, I'll buy a few more shares. If it keeps clocking up like AbbVie did, eventually I will switch out. If I think the economics of the business change or outlook on the overall profitability of the business starts to decline. Right now they're closing stores, but they're closing the non-profitable stores. Guys, in my town alone, there are like 4 or 5 Walgreens in like a 30-mile radius. Like from Cedar Rapids to Marion, where I live, there's like 4 on the main strip, which would be First Ave. There's one by my house. There's one on First Ave. There's one down the street from that one, and then there's one like in Marion. So there's like 4 or 5 of them in my town, and you can't tell me that they don't cannibalize each other. Like eventually, there's so many Walgreens now that you can go. There's not like a. It's kind of like how Subways are as well, and I know they've been closing locations. Like they cannibalize each other, which just means that there's no customer loyalty to a certain location. When there's so many locations, people can go down 2 blocks and get another McDonald's, or 2 blocks and get another Subway. So I think what they're doing is a smart idea, because they're taking away some of those lower profit locations, so they can push them towards ones that are doing better overall, that maybe have a better sales per customer, or better prescription sales, something like that, maybe better staffing. Overall, I think it's a good thing for the business. I know it's seen as a bad thing, but cutting out a low profit store that barely makes it by when you factor in rent, utilities, etc., closing that store and giving some of the staff to the more successful stores that have a better margin is an overall better business decision, I think, than leaving dying stores out there. Just my opinion. But if I was in Walgreens' shoes and I saw that there were some low profitable stores and there were 6 locations or 5 locations in a given location, like in a 50-mile radius or 30-mile radius, whatever, there's 5 of them. It's one every 5 miles. So it's like, I get why you'd click. there's a couple in our town. They're not closing in our town, but there's a couple in our town that you could probably get rid of, and people relatively wouldn't notice that they'd be gone because there's so many. There's literally two by my house within 5 miles of each other. So it's like it's either I go to the one that's like up a block or up 3 blocks. So see what I mean? So it's like it depends on where I'm driving. But then if I go to like Marion, there's like 4 on the way there. So I think overall, I mean, I could get bit with this. It's fine. If they cut the dividend by less than 50%, I'm still ahead. And I think overall, their new CEO has really shifted in the right direction when it comes to the overall business. It's one that I'm definitely this is definitely going to be one that I keep a very close eye on. I'm less comfortable with Walgreens than I am with, say, AbbVie or Altria or Coca-Cola. It will not be in the top 5, but it's still going to do exactly what Altria does, right? Overall, I think Altria is a better business than Walgreens, but it pays more money, which will mean that now I will be able to purchase a near share of Visa every 36912 if I want to. So now Altria buys Apple, and then AbbVie buys Walgreens, and then Walgreens can buy Apple or Visa. So this is just gonna or Coca-Cola. So overall, I think this is just really going to put the pedal to the floor and help with that passive income. Guys, I put the same amount of money that I had in T Rowe into Walgreens, and my income went up more than 50%. So even if the stock price doesn't go up, long as the dividend stays where it's at or is above what T Rowe Price paid me, we're in the green. And then for the watch list, real quick here, Google, I don't want to buy it around 170, so it's got a long way to fall for me. My average cost when I had it last time was 158, so 160 is about where I had it. I made money on it, but I want to own Google because of YouTube. Honestly, Google search. This is one of the best tech companies in the world, and it will be in my top 5. I wanted to go Apple, Visa, Coke, Google, Berkshire. And then last but not least, we got Berkshire Hathaway. Guys, I want to own it because Warren Buffett, because Charlie Munger, because of the great overall, like in the way that they have such a great way of managing capital that does not end with Buffett. They have such a good team there that I'm not worried about when Buffett passes. The stock, I think, will go down, but Greg and Ajit are amazing. They have a great culture within the company, and it's one that I want to own for the long term. So I do want Berkshire to be one of the biggest. Eventually, it might overtake everything else. It just depends on how much of a fanboy I want to be. But in overall, where the valuation is when what I consider a good price. But eventually, it will bump up in the rankings. It might even be the biggest position over Apple because I love the businesses there. I've been to 3 meetings now, but we go every year. They own Dairy Queen, they own Geico, they own National Indemnity. They own so many different businesses. Plus, they have a great insurance business in Geico, National Indemnity, and all the other. They own so many insurance companies now too. So as long as they are consistent, and can find relatively acceptable, because at their size it's hard, deals to make, I'm not worried. And I know a lot of people are worried about the big cash pile they have. Yeah, when the amount of companies they could buy with that cash pile when the market has a downturn is insane. So I'm excited to see what they do. But overall, guys, Berkshire is definitely going to be in the top 5, and I'm excited to own it. I want it around that $400 mark, so it'll be a while before I think it gets down to there. But overall, guys, I'm excited for the portfolio. Just going to keep using those dividends to reinvest. Once the debt's paid off for me and my girlfriend, we will start throwing money into it. Start putting $400 to $500 a month in. Right now, I'm going to try to do $300 a month once her car's paid off, and we'll see how fast the portfolio grows. Thank you guys so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy, and I'll see you tomorrow with another Robinhood portfolio update. Thanks, guys.